Good morning. It is Wednesday, January 25th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Salzi, and here's what you need to know as the clock hits 9 a.m. Stormy clouds ahead for Microsoft. The company warns there will be more deceleration ahead after reporting its slowest revenue growth in 6 years.
Plus, a breakup at Google. The Justice Department just sued Google to break up its advertising empire, but what would that look like? And can it even happen? We're going to bring you the details.
And trouble in the skies. Shares of Boeing skidding in the pre-market after the company missed estimates on the top and bottom lines, blaming labor and supply challenges for the disappointing numbers. But first, let's get a quick check of the futures here as we get really a lot of earnings reports out this morning. Not many of them quite good. We're seeing futures down across the board. Dow down about 285 points or so. Now let's get to our top story for this morning. Microsoft's earnings initially got a few high fives on Wall Street after the bell yesterday, but it was a different story on the earnings call when CFO Amy Hood emphasized caution ahead as the company issued gloomy guidance for the cloud segment.
We are seeing customers exercise caution in this environment, and we saw results weaken through December. We saw moderated consumption growth in Azure and lower than expected growth in new business across the standalone Office 365, EMS, and Windows commercial products that are sold outside the Microsoft 365 suite. From a geographic perspective, we saw strong execution in many regions around the world. However, performance in the US was weaker than expected.
Well, this was the earnings call, guys. I think Microsoft was really or has been reading its own press clippings. They talked about slowdown in their business, that word of net note of caution. I have more of this now in a story on the Yahoo Finance homepage, but played up that theme of caution in what customers are buying and selling, but then also tried to pitch the street that, hey, we have ChatGPT and maybe that will change the game fundamentally for us over time. And it might. But the street is more focused on the now, Brad, and what that caution might mean to the next couple quarters of sales and profits from Microsoft.
Yeah, AI being the big word and buzzword that we might continue to hear, especially from tech companies over the course of this earnings season. But I think when you have to factor in that next leg of growth and when it actually will come and what kind of expenditure that dollar figure is going to come off of as well, that puts even more pressure on what the operating and profit margins look like to continue to invest in some of those efforts going forward. So when you hear about, for one of their most profitable segments in Azure, the type of deceleration in growth that they're anticipating and already seeing in some instances. North America, they pointed out here in this most recent earnings call as well that we just played a clip from, that certainly puts some cold water on how long investors would have to wait for that next leg of growth. And I'll tell you, there are two instances where we saw not just a downgrade this morning off the back of this report, but one firm that got this right weeks ago was UBS. They had lowered the stock to a neutral from a buy and cited many of the very issues that investors became a little bit more clear about over the course of this earnings call and after the earnings as well.
So if you're talking about a deceleration here from the 31% growth that Azure saw, they're talking about a 4 or 5 percentage point deceleration from that low 30s percentage point. But you look at some of their other groups here and what they were seeing, it was sort of a little bit mixed. I mean, Azure, as I mentioned, saw 31%. It's part of Intelligent Cloud, which was up by 18%. But personal computing revenue was down 19% as part of that. Windows-related revenue was down 39%, and hardware devices that the company makes down 39%. Gaming revenue was down 12%. So cloud in the form of Azure has really been, to your point, the profitability, growth. It has been the driver for Microsoft as of late at a time when other parts of the business are not working as well. All of that said, you mentioned UBS in its call. Looking over a lot of the analyst commentary this morning, many of them are saying these are sort of challenges not unique to Microsoft, and they don't seem that concerned about the company's long-term growth trajectory absent these couple of quarters that are going to be tricky. Yeah,
well, now I think you're getting more clarity, of course, on why they laid off 10,000 people last week and why, as a lot of these software companies report their earnings, you're probably likely to see that justification for the layoffs that they did. One number that caught my attention on their earnings call, guys, 280 million. That was the number of users for Microsoft Teams, which has just turned into a complete juggernaut. And in a few weeks, we'll hear from Zoom. And I have to wonder if Teams is just starting to absolutely pummel Zoom in a market where a lot of these key small business clients for Zoom and Microsoft just might be consolidating onto Microsoft instead of Zoom. But wow, that is, the growth in Teams is just absolutely taken off, and it doesn't really appear to be slowing.
Yeah, and that was really the competitive advantage that Microsoft had over Zoom, and that Zoom, for much of the time that it's been publicly traded, has been a one-trick pony, and it continues to be thought of among the portfolio client base that they have as just that. For Microsoft Teams, it's integrated into a broader suite of solutions, collaborative tools that Microsoft has been able to sell into corporations for years, and then acquire specific add-ons to sell further into that portfolio of clients. And so that was always kind of one of the bear overhangs, or one of the headwinds for Zoom, is that you're going up against a behemoth in Microsoft that can accelerate based on the install base that they already had when they did roll out that video product in concert there too.
Yeah, and talking about competition, getting back to cloud for just a second, we are seeing the depressive force of the juggernaut that is Microsoft on the other cloud stocks here
Dark cloud over
this
the
morning.
space, Julie.
Exactly.
Dark cloud.
Because as I mentioned earlier, if these are reflection of caution on the part of clients of Microsoft, as we heard from Satya Nadella, then that's what we're seeing for clients of other cloud companies too, most likely. And so we're seeing the whole complex that is trading lower in today's session here.
Absolutely. Well,
Microsoft's closely watched cloud business Azure, as we said, did slow year over year in the latest quarter. The company warning of uncertainty ahead. Let's check in on how Azure could rebound in the coming quarters and get Wall Street's take on the company with Piper Sandler equity research analyst Brent Bracelin. Brent, thanks for being here. So when you look at that cloud deceleration here, how acute do you think it's going to be? Obviously, the stock is being punished for that. Do you think it should be?
Actually, I'll have a little bit of a different take here. Listen, if you look at the cloud industry, this is a market that's gone from an early cycle adoption period to mid-cycle. When I say early adoption, cloud was a $10 billion industry going back to 2012. It's a $385 billion industry today. Microsoft's the leader in cloud. Azure is one of the faster growing parts of cloud. But we're going from a very large market with hypergrowth to now an industry that's going to have healthy growth. The overall cloud market will slow to less than 20% growth in 2023 for the first time. And so I think as we think about framing Azure, framing the moderation in Azure, these are just law of large numbers. Azure is still going to grow 30% constant currency, 26% this quarter. That's faster than we think the overall cloud industry will grow this year. So they actually still are gaining share in cloud. I actually think the Azure numbers were better than I had feared. I think the bigger concern on Microsoft is their non-cloud business. The non-cloud business for Microsoft is a $100 billion business that declined in aggregate 13%. It's going to decline by double digits again. So I think what's the market's grappling with right now is not necessarily a slowdown in cloud. That's anticipated, and it's probably not as bad as feared. The bigger concern is this $100 billion non-cloud segment that might be more cyclical than people appreciate. And that's the concern I think that people have, institutional investors have. That's our primary fear, is the slowdown in their non-cloud business is happening much worse and is a little bit more cyclical than investors appreciate. So that's, I think, the primary issue we're focused on and what's dragging down earnings here short term.
Brian, in addition to slowing cloud revenue, we saw weakness in the PC business. We saw weakness in gaming. We saw advertising weakness in LinkedIn. Given all of that slowing, do you just sell Microsoft shares on the thesis that all these trends just worsen from the first quarter to the second quarter, and we don't get a bottom in some of these growth rates until later this year?
Yeah, we're going to bottom here either this quarter, the current quarter they reported, or next quarter. So we're close to basically seeing the worst decline in some of these non-cloud segments like Windows and devices and advertising. So I think we're closer to kind of a growth bottom in Microsoft than maybe people appreciate. We actually took numbers down this year, fiscal year ending in June, by less than $1 billion. We were street low. We took numbers down by about $2 billion for next year. We were street low, but we actually kept EPS in line. So we actually think with some of the layoffs, with some tight expense management, yeah, EPS could decline here in fiscal 23, but in fiscal 24, we can see a trend back to double-digit EPS growth for Microsoft. So we're in the eye of the storm. I like to call it the darkest before the dawn. We probably have another quarter of some challenging numbers here in the non-cloud business, and then I think it stabilizes from there. So I think these concerns on Microsoft are really short-lived over the next quarter, and we'll start to see stabilization going into fiscal 24.
The darkest before dawn period certainly sounds analogous to what the crypto community would call a winter, if you will. And so even within this kind of darkest before dawn scenario where Microsoft still has to invest in its cloud business, invest in its advertising business, and it sounds like AI could be kind of a dual component, or at least an investment for both of those businesses as well. But is AI the savior for Bing? Is AI the savior for, or the next leg of growth for its cloud business, especially when that's been in some competitive clouds already?
Listen, generative AI is super exciting. ChatGPT is caught the attention of the world here and the promise it has. But let's be clear, Microsoft's a $200 billion revenue business. For generative AI to become a material impact on Microsoft, I think that's going to be measured in years, not months. If you're a startup with no revenue, absolutely. ChatGPT, these generative AI models can absolutely have an impact in 2023 on your growth rates. Microsoft's just too big. So I think it's going to take years for generative AI to really have a material impact on Microsoft's growth trajectory. I think it absolutely will. We're very bullish around these large AI models and the impact it's going to have on software. These are big platform plays. This feels like the beginning of kind of a new internet-like era going forward, but it is very, very early. I'm cautious getting too excited about a trend. I think Amara's law applies here, and do suggest a little caution, even though this technology is really, really promising.
Brent, on that front, we've been talking about ChatGPT sort of amongst ourselves, and Brad was joking yesterday. He was talking about it at brunch over the weekend. Like, it's become part of the popular consciousness. But we were trying to remember this morning, IBM had Watson. We had almost forgotten that existed, right? We've had other waves of these AI developments that promise to be changing in a big way. Is this time different, even if it is early, in this new wave of AI?
I think it's different, and I think it's important to frame the pace of change. If I think about like software is being powered by Moore's law, by the number of transistors doubling every 2 years for the last 40 years. If you look at the pace of change with some of these large AI models, we're talking not a doubling of transistors every 2 years. We're talking about a 100-fold increase in intelligence every year. So it is something to watch closely. Things are changing very fast here. I think it is different because the pace of change is different. But again, we have to go from the lab to production to convincing large enterprises to adopt the technology. Things typically happen first in the consumer and then bleed over into the enterprise where there's security and data governance requirements. But no doubt, very exciting to talk about what the potential is here. It is different, I think, than Watson, but again, very early.
Brent, Microsoft really obviously, of course, played up GPT on the call last night, but also talked about it putting it in other software applications. My interpretation was it may show up in Teams. It's going to be used to help sell more cloud services. Are Microsoft's cloud rivals, Amazon and Alphabet, working on similar technology to prevent Microsoft from coming in here and just gaining a lot of market share?
If you look at some of the industry folks that are really close in the weeds around generative AI, I think there's a belief that, yes, ChatGPT was based on an OpenAI GPT-3, 3.5 model. That's kind of what we're talking about now. There could be a dozen different large language models by the end of the year. So there's going to be a lot of other folks leveraging other AI models in different ways. So I don't think it's a singular OpenAI game. I think it's just going to have multiple players. We're really, really early. So it's going to be fascinating to watch. It's going to be exciting to watch. But again, I'll stress, we are in the very nascent stages of adoption, but things will happen fast.
Piper Sandler equity research analyst Brent Bracelin joining us this morning. Brent, thanks so much for breaking down the earnings with us.
You're welcome.
Microsoft said that it reversed a network change believed to have prompted an outage that happened on Tuesday, which resulted in thousands of customers losing access to its services like Teams and Outlook. The outage lasted for 4 hours and impacted many across Europe and Asia. This happened just hours after the company reported earnings. And coming up, big tech backlash, the DOJ calling for a breakup of Google. We're going to break down what that could look like next. The U.S. Justice Department has slapped Alphabet's Google with another antitrust lawsuit regarding its dominance in the digital advertising market, with the DOJ aiming to break up Google's branches of businesses. What would a shakeup mean for Alphabet? Yahoo Finance's Dan Howley and Yahoo Finance's Alexis Keenan join us now to break it all down. So, Alexis, let's start with you. What can you tell us about this from a legal standpoint?
Yeah, so this is a lawsuit. It's a federal one. It's an antitrust suit. It's brought by the Department of Justice along with 8 U.S. states. They're going after Google's online ad market, saying that the company is illegally using its monopoly in that space, or at least trying to, in order to block competitors from entering. The complaint says that Google has thwarted meaningful competition and deterred innovation. The analogy they give here is saying that it's like having Goldman Sachs or Citibank own the NYSE. So let's talk about the size of this ad market, this online ad market. It's approximately $278.6 billion, and Google, for its part, is the top dog here, controlling most of the technology to buy, sell, and serve advertisements online. In 2021, Google's annual revenues in this space, $209.5 billion, and in the third quarter of last year, revenue reached $54 billion. Now, as a fix, the DOJ and the states, they say they want this alleged illegal behavior to be repaired by forcing Google to divest certain of its ad tech entities. Specifically, they say at a minimum, they want Google to divest its ad manager suite, and that would include its publisher ad server DFT, also known as DoubleClick or GAM, and also its ad exchange ADX. Now, one challenge that Google faces here, a major challenge at least, is that the DOJ now has multiple antitrust actions, as you mentioned, against the company. They're already facing a suit from the DOJ on its search business in that market. And also, though, a challenge on the other hand for the DOJ and for the states here is that one that's come up in multiple antitrust suits that have been brought by both the Trump administration and the Biden administration is that it's really difficult to show that victims are being harmed when services are free. So in the case of search, we all know that to be a free service that Google / Alphabet is providing, but maybe they'll have a little bit better chance here, the DOJ in the states, in that the ad market does have dollars exchanging hands. So they might have a little bit more of a leg to stand on, or at least in turn getting courts to accept some of these arguments that are novel ones at that.
Yeah, it's always tricky to figure it out, although the saying is the product is us, right? It's not really free. Dan, let's turn to you. You know the company well here. So we're not talking about a breakup here of the different distinct businesses, really, of Alphabet. That's not really what we're talking about. So what would a breakup look like in theory?
Yeah, it's basically the ad business side of things. And, if we do get a breakup of that side of the business, we could see lower revenues for Alphabet, Google, over time. And, when you look at a company like Google, the vast majority of its revenue obviously comes from that advertising business. It's, lack of a better word, it's an ad company. And so they use that revenue to basically subsidize a number of features that they offer, whether that's, investments in its self-driving car business or, its hardware business. So, they may end up having to cut back on some of those if their ad business does end up being forced to break up as the DOJ is seeking. So, this isn't a huge breakup of, YouTube's getting split up, Google search is getting split up, Android. It's not that, but it does cut directly to the heart of Google's business. And so that's why it could be troubling for them.
Dan Halley, Alexis Keenan, thanks so much. Appreciate it. Coming up, Texas Instruments joined Microsoft in serving up downbeat guidance on its earnings call last night. We'll dive into that outlook and overall report next. Let's check in on some other trending tickers not named Microsoft. Chipmaker giant Texas Instruments posted an earnings beat for the fourth quarter, but had its worst sales decline since 2020. The company also issued weaker than expected guidance, kind of like Microsoft for the first quarter, as CEO Rich Templeton pointed to slowing demand in all end markets, except, I should add, the auto market. I beat you to it, Julie. But overall, seeing weakness in lots of different places. Also worth pointing out, the industrial end market, which is about 40% of Texas Instruments' 2022 sales there declined 10% sequentially. That is a huge, huge drop.
Yeah, and for Texas Instruments, they had shifted a lot of their business. Of course, many of us know them for the TI-81 Plus calculators from way back in the day. But even beyond that, I think within the functionality of vehicles, that's where they've really been able to kind of really paint themselves this lucrative corner, as long as they're continuing to be able to, like many other of the chip manufacturers, make sure that the materials that they need in order for them to service many of the vehicles and the broader market there, that continues to come online. But I think for Texas Instruments, some of the other tailwinds that they could see also showed up for ASML too, and particularly what that looks like more internationally is what ASML had called out in China particularly.
Yeah, I mean, if you look at these two, they're a good early read on what's going on in the chip industry. Texas Instruments has the longest list of customers of anyone in the chip business. It just makes chips that go into everything. And so it is interesting that everything except auto was not doing great. At the same time, the company is saying it has no plans to cut jobs. So it is it feels like the semiconductor industry is waiting for the next upswing, right? We are in this down part of that chip cycle, but maybe we're going to get back up there. They don't want to let people go in anticipation of that, perhaps. When it comes to ASML, interesting there because the numbers were better than estimated, the sales projection better than estimated, but ASML calling out some of the Chinese control measures, or the sort of getting caught in the middle of the ongoing tension between U.S. and China and the effect that could have on sales. So that seems to be more of a pressure on that stock than the actual numbers.
I do wonder if TI will have to start or look at least layoffs. A couple things in addition to add here. They did notice an increase in cancellations in the quarter, along with some customers pushing out orders. So that is, you never want to hear that. And then secondarily, their first quarter EPS guidance, 164 to 190, was really well below consensus on the bottom end of 186. So a big whiff there. And job cuts, announcements of that have been rewarded by the market. So we'll see.
Yeah, keep a close eye on the SOXX as well. I share semiconductor ETF. I've been tracking this one, and even in last year when you had some of the more significant declines across the industry, or across at least this sector here, and it was down by, I believe it was about, doing some quick charting here, by about 35% last year, 36% last year. However, early year, January right now, up by about 14%. So some of that rebound, or at least some of the prospect of this industry turning, is starting to be priced into some of these shares too.
Yeah, I mean, I think the other thing is, as we talk about all of these industries girding for a slowdown, even in boom times, the semiconductor industry is used to being highly, highly cyclical because it is a commodity industry that tends to experience these inventory gluts and then, shortages. So perhaps also the people who cover the industry, the people who invest in the industry, maybe they're a little bit more used to this sort of up and down cycle. Yeah. I don't know. I'm just spitballing here.
Yeah, no, it's fair. Well, you did get the sense that TI is pulling back on investments. This company remains very aggressive in building out capacity, which is weird, to your point, because demand seems to be falling off a cliff.
Well, and a lot of this capacity build that we're talking about for the semi industry right now is very long-term anyway, especially when we're talking about some of its competitors building new plants in the U.S., for example. Mm-hmm. I mean, that's not something you're going to cancel overnight, because you're seeing 2, even 3, even 4 quarters of declines, right? If you're building out the factory for 2025 or 2026.
Right, Brad, you mentioned the calculator. I recently got a TI last year, and it was cool because you're able to plug it in and recharge it. And I thought back to when I got one in 5th grade. It was like $150, had batteries in it. So talk about technological wonders. That's it for me.
You voluntarily went out and got one, and
it wasn't. I have my bag. I'll show you after the show. Yeah, it's a great show. I travel with it. It's good. I like the calculator.
I travel with my calculator too. It's my phone.
Well, no, it's nice. You don't feel the buttons though.
The functions. You got to do all the functions.
You got to put graphing on that too.
Yeah, here's the opening bell on Wall Street on this Wednesday when we are feeling a little Microsoft hangover, I think, on technology and in the markets more broadly. That combined with the likes of Texas Instruments and some other earnings disappointments there, definitely putting pressure on stocks here at the open and continuing to bring a halt or at least a pause to the rally that we had been seeing in large cap technology.
If Microsoft is warning about slowing growth, I can only imagine what some lesser companies are about ready to report. Those fundamentally challenged companies like a DocuSign, that could be a real big fat whiff of a quarter.
Yeah, well, we're opening down, so we'll see what continues to unfold through the earnings season. Brad, what are you seeing at the Interactive?
As of right now, I'm seeing some declines, as you were mentioning there. Opening down here, let me populate this chart for our viewers at home. And you know what? I'll give you a view of what's taken place over the course of this week thus far. Net, 3 days, past 3 of them, you're up by about 0.3% on the Dow. But here today, you're actually lower by about 0.7%. So we'll keep a close eye on that. The Nasdaq Composite flat over the past 3 days, just barely to the upside. However, out of the gate here today, down by about 1.7%. Bet your bottom dollar that some of the tech sector, XLK, that we'll check in on, is certainly going to be impacting the broader tech space, and that'll be showing up in some of the price action that we're seeing here out of the gate. S&P 500, that's down by about 1.1%, flat over the past 3 days, but just barely to the downside there. Let's also check in on those sectors here. As I mentioned, 11 S&P 500 sectors, and leading the way, at least to the downside. Yeah, I said it a moment ago, and that was kind of a guess, but also a educated guess, I guess, given what we've been discussing here today. It's down by about 2%, leading the declines. And then the best of the worst, if you will, is healthcare. That's lower by about 0.4%. All 11 S&P 500 sectors in negative territory. And let's just take a quick look at some of the megacap tech stocks. Apple also lower by about 1.9%. Amazon down nearly 4% out of the gate this morning. So we'll keep a close eye on those as well. But they're Microsoft, aforementioned and much talked about, lower by about 3.2% right now.
Yeah, and look how dark red Amazon is there at the
very
top
dark.
of the screen.
That's maroon.
That is, I think there was also a price target cut for Amazon here this morning, in addition to the sort of ripple effect from Microsoft. So that might also be why the stock is down.
Yeah, year to date, still holding on to some gains by about 10%. But of course, if you stretch this out to the past 52 weeks, Amazon lower by about 34% over that basis. But here today, yes, some lake red indeed on the screen. You've also got some lake red on the shares of Airbnb, ADP, also lower. They've reported earnings this morning. And then Booking also, that's down by about 3.2%. So
Right, what kind of lake is that? Lake
What
red?
is lake red?
What is
lake
that?
red? It was a Crayola color growing up.
I do wonder about the kind of lake that would be that kind
Yeah,
of
because
red.
like a horror movie.
We gotta
Like a
look
Red
at,
Sea,
yeah,
yeah.
we gotta look into this more. We gotta do a little research. We gotta call people Crayola and find out what's up with that. All right, let's talk about another mover here this morning. That is Boeing, which came up short in its fourth quarter earnings as the company reported its second consecutive loss, missing on both the top and bottom lines. Yahoo Finance's Pras Subramanian joins us now to break it down. Pras, obviously Boeing has been digging out of a hole, to put it mildly, I guess, you know. And so this quarter shows maybe that they still have a ways to go.
I mean, I needed that calculator sauce this morning when I saw this.
Well, I have it for you. It's in my bag, buddy.
I mean, surprise loss, revenue missed there. You know, revenue slowed 45% from last year, with a horrible year last year with plane deliveries and things like that. But, you know, not enough for the street. Again, they reaffirmed the guidance for the year, kept it the same. Not enough for the street after that rough year. Deliveries, 152 planes, so that was good. Up 50% from a year ago. Bulk of those were 737 Maxes and 22 Dreamliners, so that was good for them. Order backlog stood at $4 billion. But I think from the call, it's going to be at 10:30 with Dave Calhoun. I want to hear more about this. You know, what's next? That triple body, the wide body jet is actually going to come out. Anything related to supply chain issues that they had last year, and then also kind of more on that backlog. Are they seeing any demand sort of concerns? Are airlines still kind of wanting to increase their inventory of jets? Is that still happening? Is that still going to be a trend in 2023?
Yeah, and that was the major mover last year, was the number of orders that they saw come in. You had a record order, at least from United Airlines late in the year. And this is, many kind of airliners are looking to revamp their fleet as well, even as they're restoring capacity. Part of that is these purchase orders. So where has that continued to be talked about from the company's perspective, and really getting through that backlog as well?
So backlog up, what, 270 million compared to a year ago. So and that's like a few jets, not a lot, but it's still better than before. I think it's more about executing and getting those jets out the door. It's like $4 billion in confirmed orders. They need to actually make these planes. You know, post-pandemic, we've seen airlines, demand has gone up through the roof, even with sort of macro concerns here. So I think it's more about can they actually execute and beat their rival, Airbus. Airbus is kind of killing it here, and they need to kind of catch up. And before Boeing was the standard of the world, and now it's more Airbus.
Right. The Neo being that rival to the Boeing 737 MAX, especially considering some of the orders and how that was slated to be kind of an entrant into many of the fleets for airline operators as well. Yahoo Finance's Pras Subramanian breaking down all things Boeing for us this morning. We'll keep a close eye on the ticker symbol as well and the movement there. Let's also talk about Abbott Laboratories. Their ticker symbol ABT topped earnings for the fourth quarter. Sales fell 12% due to manufacturing disruptions to baby formula as well as year-over-year decline in COVID-19 testing related sales. For more, we welcome in Yahoo Finance's Anjali Kamlani. Anjali, what do we know about the results from Abbott Labs this morning?
Well, as you mentioned, Brad, of course, we know the pressure from the manufacturing issues that they faced for the baby formula, as well as a decline that they've seen in their COVID line of business. It is actually causing the company to have a more conservative outlook for the upcoming year. But for the fourth quarter, definitely saw a little bit of a decline in the COVID testing sales. However, they did get a little bit of an increase, just like other companies in this sector, starting to see a little bit of increase in other medical devices like their heart line of business, as well as diabetes, a main focus for Abbott. But looking at COVID in particular, CEO Robert Ford saying this morning that, they're looking at it as more of an endemic type of setting. So, for example, in the fourth quarter, sales of that COVID test, 1.1 billion, 95% of that coming from those rapid tests. Meanwhile, for the outlook for the year, just 2 billion in total in COVID sales. So that should just give you an idea. They've also reduced their EPS guidance for the year. And that's really just a matter of, seeing a little bit more conservative outlook from this company that has known that COVID has been part of their story for the past 2 years. And so that is coming off. And so, CEO Robert Ford also saying this morning that their growth for the coming year is going to start looking a little bit more like picking up from pre-pandemic levels versus the really surprise growth and the strong growth that you saw in the past 2 years.
Anjali, on the infant formula front, now the nutrition unit, which is where the infant formula resides within the company, it's not the biggest part. Medical devices are a bigger part of the company, but did we get any more color as to how much that's going to continue to cost them? They've said that they expect inventory levels to get back to normal this year. Are they spending a lot of money on upgrades of their facilities, et cetera?
They already have mentioned some of that, and we have to remember, of course, they're still being looked at, criminally investigated by the Justice Department. But on that front, yes, a little bit more investment there. They're looking outside of the government programs, in particular, looking to grow and restore the supply on the shelves in the broader commercial market. That's really the focus for the company right now, is to get back to normal. We know that they've, of course, been facing a lot of competition as they lost their footing as the lead in the nutrition department in the baby formula sector. So that is definitely something that's a focus for the company.
Yahoo Finance's Anjali Kamlani breaking all things Abbott Labs down for us here today. We'll keep close tabs on ABT as we move on. Thanks so much. Guys, coming up, Yahoo Finance's Jared Blickery going to break down what's moving at the open next. Welcome back to Yahoo Finance Live this morning. Taking a look at the major averages. We are red across the board for the 3 U.S. major averages. Let's get more on today's tape with Yahoo Finance's Jared Blickery, who's over at the Wi-Fi Interactive. Hey, Jared.
That's right, Brad. One of the charts you showed earlier, which is a 3-day, week-to-date chart of the Nasdaq, caught my eye because when you showed that chart all around the open, Nasdaq had given back all of the gains and had been at zero. But you can see it's in the green for about 1/4 of a point today. Now, the S&P 500, very similar situation, just barely green for the week. And the Dow, which has been lagging this year, now leading. It's up about 43 basis points, but nothing to write home about just yet. Want to draw a longer-term chart or look at a longer-term chart of the S&P 500. Let me make this a line chart. We are just barely breaking through this negative trend line right now. We got the 200-day moving average. And over the last few days, and this is a 3-day chart again, we are selling off from what has been a very contentious level, not only in the S&P 500, but also the Nasdaq, 12,000, about 850 points above the current level. Very big level here. Let me just show you a 2-year chart of the Nasdaq so we can see here. Consolidating in this range, 12,000 would point to probably a nice squeeze above current levels, but we don't see that just yet. And let's take a look at the bond market. 5-year T-note yield, it's down about 2 basis points, nothing big going on there. 10-year down 2. And let's take a look at the shortest end of the curve. That is the 13-week T-bill yield. And we can see year to date, that has been climbing and very much holding at some of these elevated levels near the highest that we've seen in probably 12, 14 years here. Here's the sector action today. We got everything in the red. Financials are outperforming. Those are still under the weather by about 0.25%. Tech, as we've been talking about, those Microsoft earnings really weighing on the market, followed by consumer discretionary, utilities, and energy. All of those are underperforming the market right now. And let's check out the Dow. We can see Microsoft there down 3.4%. Some of the names that we're seeing in green, the more defensive ones, Verizon, a telecom company, communication services, United Health, healthcare, Cisco, that kind of a defense stock, if you can think of that one tech stock that way. But let me just close here showing you what's happening in the software world. A lot of the cloud companies like Team there, Atlassian down 5%, Snow, that's down 5%. I think we're going to see some more fallout from the Microsoft earnings throughout the day.
So true. Jared Blickery, thanks so much. All right, recession fears are still swirling, but that hasn't stopped some from making speculative bets in fundamentally challenged companies. Total of 6 Russell 1000 stocks are up more than 50% this year, points out the folks over at Bespoke. So Terra Health leading the charge with a more than 100% gain. Yahoo Finance worst company of the year for 2022, Carvana, also getting a boost from the speculators with a big gain of its own. Straight ahead with earnings season clearly off on the wrong foot for the bulls. Is it time to get more defensive? We'll discuss next.
Despite a slowing rate of inflation, investors are still bracing for a possible recession. Our next guest is recommending some lesser-known stocks you should look to in this environment. Bowersock Capital Partners founding partner Emily Hill is joining us now. Emily, it's great to see you. Let's set the stage first before we get to your picks, because everybody seems to be in agreement here that there's a slowdown underway, whether we tip into a recession or not. So in this environment, when there is sort of this consensus about where we're going directionally, is it tougher to make money at a time like this?
Well, I think there's some good opportunities out there. I do think actually that the consensus going into the end of the year was very bearish, and we're getting a little bit of a softening there, a little bit of a disparity between the bears and the bulls. I am in the camp that frankly is expecting the markets to revisit the lows set last fall. And I do think it's a time to continue to be cautious in stock investing. We like bonds, we like international stocks, but in U.S. stocks, for people who like to invest in U.S. stocks, we're looking very long-term at some global trends. We're long-term investors, by the way. We're not investing for 3 months or 9 months or even a year. So yes, I believe that answers your question, but we do think there are opportunities despite our generally negative outlook on the stock market.
Where are the opportunities?
We like international stocks for people with a strong stomach. We like small cap stocks, which are trading at a larger discount versus large cap stocks than we've seen since the early 2000s. Again, we like bonds, we like treasuries, and we like certain pockets. I think there are really good opportunities out there in certain sectors of the economy. Earlier in this program, you were talking about semiconductors. We like semiconductor equipment manufacturers like Lam Research. And, we are concerned about some global trends. We have been through a period that really kept a lid on inflation through globalization, through favorable demographic trends, the end of the Cold War, a burst of innovation. And a lot of those trends are now reversing. And I don't think the market is taking into account the cost of climate change. So we're looking for companies that would benefit and thrive in a setting where we have continued supply chain shocks and that benefit from scarce resources. And I would put in that category Ecolab. They are one of their sources of profit growth comes from the industrial water business and basically ensuring supply of clean water for companies around the world. And we're expecting in the US that the cost of fresh, clean water will double by 2030. So what companies are out there that can take advantage of that trend?
Sure.
And Ecolab is one of them.
I want to come back to something that you were mentioning a moment ago within semiconductors, because one thing that I did highlight from the ASML CEO was them saying that they expect the market to rebound in the second half of 2023, or at least that's what customers of theirs are indicating. And so when you hear something like that from one of these semiconductor companies, and perhaps it's largely felt across the rest of the industry, even though it's tough to time the bottom of something, does that give you pause to say, you know what, we don't want to be paying 15, 20% more for something than we could or should be?
Yeah, I'm not a big fan of timing the market. A company like Lam Research, which is going to benefit, as you know, semiconductors are in part now a national security issue. And so we're going to get a redundancy in fabs, which will benefit the equipment manufacturers. Now, Lam Research, along with the rest of the semiconductor sector, is up about 15% year to date. So is it the perfect time to buy it? Probably not. And so again, I'm not a fan of timing the market, but the time to buy Lam Research was late December. And I think we've seen a big rally in some of the junkier parts of the market, broken IPOs, low quality tech, and a lot of the speculative names. And right now there's so much uncertainty in the semiconductor sector that, I would put them in that category. So, if you're a person that absolutely wants to try to buy at the bottom, you could benefit from waiting.
Emily, the commentary from Microsoft last night was not rosy by any stretch of the imagination. We're seeing stocks under pressure here. Do you think, in the context of that commentary, that the broader stock market is overvalued at current levels?
I do. I think it was fairly valued going into 2023. And, we've had a big rally driven by what's still an enormous amount of liquidity in the economy. And, it's interesting. Investors are not getting the Fed's message, and it's a little bit puzzling. And, if you're the Fed, you're thinking, what part of no don't you understand? And so unfortunately, every time the market rallies, like we have seen in the last couple of weeks, it sets back the normalization process that the Fed is trying to move forward.
Yeah, we'll see what gives as the year goes on and as that tension continues. Emily, good to talk to you. Emily Hill, Bowersock Capital Partners founding partner. Appreciate it. Coming up, Disney earnings are on tap for February. Saz is going to share his take about what to expect. That's next. We are in the midst of earnings season, but as usual, Saz is a few weeks ahead. He's looking ahead to Disney already. It's set to report results the first week in February. It's Bob Iger's first earnings call since returning as CEO. So what should investors be expecting, and how much noise will that activist fight be making? What will Iger have to say about that?
Yeah.
Saz,
I'm already over the...
Can't you just live in the moment, man?
No, man. I'm already over these Microsoft results. I'm looking forward to Disney in a couple weeks, as you mentioned, Julie. And also, as you mentioned, this will be Bob Iger's first earnings call since returning as CEO in late November and shocking, really, the business community in doing so. And Wells Fargo's media analyst, Stephen Cahall, really one of the best media analysts out there in the street, thinks Big Bob will come out swinging. He says this: we think Disney management will come out swinging on the earnings call to fend off criticism. Of course, that criticism, oh, wow, there I am next to Bob Iger. Never thought I'd be next to Bob there in that photo. Criticism, of course, coming from Nelson Peltz, the noted activist investor. Here's what Cahall expects on Disney earnings day. Ultimately, he thinks Disney will back away from the aggressive fiscal year 2024 subscriber targets for Disney Plus. put in by now former CEO Bob Chapek. That range or guidance range was 215 million to 245 million. The top end of that certainly looking optimistic given the strength or the renewed strength over there at the likes of Netflix. Next up, clear focus on direct-to-consumer profitability. The street has wanted to see Disney put up some profits here from all that growth in Disney Plus, Hulu Plus, ESPN Plus. That has not happened just yet. Maybe Iger can make that happen. Next up, a reiteration of 2023 operating income growth guidance, something to always watch out for. And the big news, at least according to Cahill, might come on cost cuts. Now, Chapek originally got this ball rolling when he was CEO, and that ball or baton has been since handed off to Iger. Cahill sees potentially close to $2 billion in cost cuts from Disney. That would be really, Bob Iger is not known for cutting costs at Disney, but that'd be a real, just a major cost-cutting plan put in by Iger to just drive better profits, notably at the direct-to-consumer business. No portfolio changes. We've seen Disney under pressure from various investors the past few years to get rid of an ESPN or spin it off. Cahill does not expect that to happen. But I did mention that criticism from Nelson Peltz here. Let's go through Disney, some of the numbers on Disney here, which I think helps explain why you're seeing Peltz trying to ultimately get this board seat. Shares of Disney down 23% in the past year. The stock is up 15% since Iger came back or was announced as coming back on November 20th. A lot of expectations that Iger can come in here and turn things around and of course, I think cut costs. And the direct-to-consumer business lost $1.5 billion in the preceding quarter, despite a lot of new subscriber growth in Hulu Plus, ESPN Plus, and Disney Plus as well. It's up to Iger to figure out how to make money from that move to streaming, which has been a very big pivot put in place by Chapek. And then again, of course, that ball is now being handed off to Iger. My take right here, I think Nelson Peltz is going to get on this Disney board come hell or high water, guys. I think he makes a lot of great points. His presentation on about reclaiming Disney makes a lot of sense to me. I think it makes a lot of sense to investors. I think Nelson wants to come in there and help drive better productivity inside of a business that has not been focused on productivity through the years. And he has shown a proven track record of turning consumer products companies around. I think he's doing that, or he started to do that a little bit at Unilever. We talked to CEO Alan Jope at the World Economic Forum. He has embraced Nelson Peltz. And then, of course, he helped really engineer a strong turnaround over Procter & Gamble.
You know, our graphics department does great work. That is a missed opportunity to put Nelson Peltz in a Prince Charming costume. That's all I'm saying. That's all I'm saying. That would have been good, right?
Well,
this one is going. This one is.
There it is.
Maybe.
This one is going to get ugly.
Or at least the ears.
Right. This
yes.
battle could very well be one of the nastiest and ugliest activist battles probably in the past decade. There is no indication that Iger wants to give Peltz a seat on the board. And just by what Disney put out last week and in statements of its own, they really hate the guy. Maybe they shouldn't.
So maybe more of like a Shrek costume.
No.
Shrek Disney? No, I don't even remember.
Ooh, I don't remember. Just DreamWorks. Isn't that DreamWorks?
Yeah, no. You're right.
Yeah.
Who's like a great Disney villain?
Always good ideas, Julie.
Jafar.
Okay, Jafar. There you go.
Multiple people. All right. Wait.
Mufasa's not a villain. Mufasa's not a villain.
All right, we're taking this out. Guys, coming up, why 2023 could be the year of high yields. We'll discuss next.
Welcome back to Yahoo Finance. I'm Brian Tuzzi here with Julian Hyman and Brad Smith. Weak outlooks from Microsoft and Texas Instruments are setting the tone for markets this morning. Right now, all three major indices are under a great deal of pressure. Dow down more than 315 points. Now here's what we're watching this morning. Dialing up a higher stock price, AT&T's ticker page is red hot on Yahoo Finance following a solid quarter. We'll talk to one of the phone giant's key leaders. And grounded or taking off, one top airline analyst stops by with his picks into earnings season for the sector. And look out below, a new survey says most people are bracing for a housing market crash. We have the analysis. Brad, over to you.
All right, taking a look at the major averages here. We're 33 minutes into trade, and we've moved actually a leg lower to our intraday lows here for the Dow Jones Industrial Average, now down over 320 points, nearly a full % in the red there. So we'll keep close tabs on that, as we will the Nasdaq Composite, which is now down 2.25% there. And there, same case, that leg lower coming in about the 9:45 a.m. marker, and the S&P 500, that's down by about 1.5% right now. If we're taking a look at some of the sector activity, no doubt that's going to be led, or at least the decline is going to be led by technology. Right now, lower by about 2.4%, getting rattled off of some of the Microsoft earnings that we've been breaking down for you. And then additionally, taking a look at some of the megacap tech stocks, you're seeing a lot of red here on the screen. We'll give you kind of an equal view on this on the day, just so you can see and get a picture of how much red. But also impacted within this is some of the largest software or cloud solutions players. You've got Atlassian, that's down by about 7% or 6.5% right now. Datadog, that's down roughly 10%. And then additionally here, taking a look at DocuSign, that's lower by 5.25%. So keep a close eye on those names. The only movers, at least in the Nasdaq 100, looks like we've got about 8 positive names right now early in trade, and led by eBay. Wow. All right. It's up by about 1.5%. Switching gears here, inflation still driving much of today's headlines, from corporate cutbacks to a chilly outlook for markets and the economy. But has it peaked? And how can it be considered outside of the economic data as well? Here with some answers, we've got Robert Dishner, who is the Neuberger Berman Senior Fixed Income PM. Thanks for joining us here this morning. Just help us break down kind of the broader scenario, the environment right now, and how investors can kind of best time the fixed income scenario.
Sure, great question. So first of all, you're right, inflation's coming in, but inflation's likely to stay, elevated, lower levels than current scenario for a longer period of time, right? So that's likely going to keep the Fed at higher levels for longer, sort of above where market pricing is. So as investors think about that, there are opportunities in fixed income today, and importantly, putting the income back in fixed income, right? So for many years, what we've seen is that coupons got reduced during the global financial crisis, and now we've seen coupons increase. For example, the coupon on a 10-year Treasury went from 1 and change to 4 and change %. So that's delivering you, 2 or 3 times the income you had in the years past. And so we're viewing this as an opportunity here, in particular, to start moving back into fixed income, giving you potential positive total return characteristics.
And Robert, this is probably the best news among investors for people who are closer to retirement, right? Who are looking to make more conservative choices in their portfolios. So when they're looking within the fixed income complex, where should they best be looking to balance that conservatism with getting that yield?
Sure. So 2 things. One of which is, what does QE do? QE tells you to sell short duration assets, so 1 to 5 year type fixed income, and it also tells you to sell high quality fixed income. And so as we move to the opposite of that, we're looking at opportunities in both those sectors. So whether that's short duration on sort of the sub-investment grade side in high yield, or a blend in emerging markets, or looking at high quality assets such as mortgages or treasuries, those also present opportunities, again, given the income potential in these. And I'll give you some examples. Take some short-dated forward paper that just priced this year at around 6.9%. A year ago, that 3-year paper was 2.3% in coupon. If you look at Bank of America, they were issuing in December 2021 at 1.5% or thereabouts. And this year, they issued that same tenor paper at close to 4%. So we're looking at, again, high quality and short duration as areas to focus on.
Robert, how would a recession this year impact the positions you have in your portfolios?
Sure. So again, as you move towards higher quality, a little less concerned about a possible recession, right? The higher ratings we shouldn't see increased default rates in the higher ratings. But furthermore, though, as we do a bottoms-up analysis on a potential outcome, we're a bit more optimistic on default rates in high yield even. So if we're looking at a 1.5% to 2.5% default rate, again from a bottoms-up perspective. But again, I think one of the things too is we think about a possible recession. The structure of the economy, as I'm sure you've had a number of folks on, is a lot different than it has been since the 1970s. And so any recession we do have is likely to be a bit more on the mild side.
Robert, in your notes to us, you talk about a theme that we've also kind of discussed at length with some other guests as well, and the stickiness of services inflation. Where, when, how do you expect that to begin to abate?
So that's a fantastic question, and it's a little bit of an issue because effectively it comes down to healthcare services. And healthcare services are effectively an inelastic purchase, right? And so, and then furthermore, we've lost healthcare workers over the past year during the COVID outbreak. So, one of the things that's going to be tough is how we see wage inflation evolve in healthcare services. The other one, which is sort of a little bit interesting, is we're also sort of short workers in car dealerships or car services. So those wages are pushing up car repairs, car insurance, and those type of things. So that is the question mark for the Fed and for the markets, is when does this service inflation come down? But the flip of that goes to the economic argument. If wages continue to increase and we're not seeing those job losses in services sectors, how deep will the recession really be?
And just quickly, what's your answer to that right now, Robert?
In terms of the recession, how deep will the recession be?
Right.
So look, we have a little bit of a different view here, which is if you look at the structure of the U.S. economy, what typically happens in a recession, right? Fed raises rates, people stop buying cars and they stop buying houses. You get layoffs in construction and auto workers. We're not seeing that. And why is that? If you think about back in 1969, goods workers were about a third of the workforce. Today, they're about 15% of the workforce. So the multiplier effect was even greater. Furthermore, going into a recession, typically anyone who's wanted to buy a car has bought a car. But because of supply constraints, we haven't seen that happen this go around. Furthermore, housing, as we've seen over the past few weeks, as rates have come down, purchase mortgage applications have gone up. So what we're seeing is until we see a material change in the employment situation, we're likely to continue to see growth, while not stellar. That's enough to for the economy to get by.
Interesting. All right, Robert Dishner, thanks so much. Robert Neuberger Berman, Senior Fixed Income Portfolio Manager. Appreciate it.
Thank you.
Looking elsewhere in the markets today, major short seller Hindenburg Research putting out a market-moving call on Adani Group. It's the family-owned businesses of Asian billionaire Gautam Adani. Here with more is Yahoo Finance's Alexandra Semenova. And this really goes straight to the heart of the empire of one of the richest people in the world. And it's having an effect across his different companies.
Yeah, absolutely, Julie. We're seeing some big moves this morning after Hindenburg Research, which is an activist short-selling firm, made a big call yesterday, publishing a report saying that Adani Group, an Indian conglomerate that runs a portfolio of energy and logistics companies, is committing what it called the largest con in corporate history. As we know, it also reveals a short position in the company. As we know, short-selling is an investment strategy that bets that a stock price will decline. It's essentially a bet on the downfall of a company. Hindenburg accused Adani Group and its billionaire founder and chairman of a brazen stock manipulation and accounting fraud scheme run over decades, partly through the use of shell companies. It also said that Adani Group has been investigated for misusing taxpayer funds, for corruption, for money laundering. And then separately, Hindenburg also flagged some financial concerns with the company, saying that it was taking on too much debt, that 7 of its publicly traded companies were were overvalued. Adani Group, of course, dismissed all of those allegations, calling them baseless, calling them a malicious combination of selective misinformation and stale, baseless, and discredited allegations. Whether Hindenburg Research is right or not, we're seeing that call wipe out about $12 billion off of Adani's market value this morning. So we'll see what happens with that.
And it is interesting, that reaction, Alexandra. Hindenburg is not some bucket shop, one person running it. They've made some big calls in the past.
Exactly. So investors have good reason to believe that Hindenburg is right here. This is a highly respected firm whose track record has been correct so far. The firm is fairly young. It was founded in 2017, but even in its short tenure, it's already established its reputation by being correct on its call on Nikola, leveling big allegations of fraud with that company and then being right. We saw the SEC use Hindenburg's research on Nikola in its trial against Trevor Milton, and it's also made some other successful calls on SPACs and crypto companies. And now, short sellers obviously have a bad reputation. There's this notion that you're betting, on someone else's failure. However, some of the biggest instances of corporate fraud in history have started because someone had a short position in a company. So they also have a role in protecting investors sometimes by exposing fraud. And if these allegations turn out to be correct, it will obviously be very consequential. This is the biggest company in India.
Good point. Alexandra Semenova, thanks so much. Appreciate it.
Thanks, guys.
All right, ahead of Airbnb's earnings in a few weeks, we are getting a very bullish call on the stock out of Jefferies. Says Jefferies team, we recommend buying Airbnb on consensus upside, recession-proof characteristics, dominant market share in the fastest growing travel vertical, and a long runway for margin expansion. The analyst hiked their price target on Airbnb to $150 from $125. Also seeing some cautious comments out of another investment bank as well. So a little mixed commentary on Airbnb into its earnings report. Coming up, Justin Bieber is settling for the cost of his music catalog after selling it in a reported $200 million deal. Julie's back with more on the Biebs and other top headlines next.
Welcome back. Let's get down to business now with some other headlines that we are following today. Amidst international and domestic pressure, Germany has agreed to send Ukraine 14 Leopard 2 battle tanks. That gives Kyiv a substantial upgrade in firepower for its fight with Russia. German Chancellor Olaf Scholz had been criticized for appearing to stall the decision, which comes as the United States reportedly will also announce a plan to send M1 Abrams tanks to Ukraine as well. Media mogul Rupert Murdoch is withdrawing a proposal to reunite News Corp and Fox Corp, indicating that he and his son Lachlan Murdoch, who is the head of Fox, determined a combination of the companies was, quote, not optimal for shareholders. That's according to a filing yesterday. The now abandoned deal, announced in October, would have rejoined the parent of Fox News Broadcasting with the owner of print operations like the Wall Street Journal and New York Post. Investors, including Murdoch's other son, James, had opposed the merger. And another musician has inked a multi-million-dollar deal to sell his publishing rights. This time, it's Justin Bieber. He agreed to sell his catalog to Blackstone-owned Hipgnosis. Although the parties did not provide financial details, Bloomberg reported in December that Bieber's stake could fetch about $200 million. Rolling Stone notes the sale is the largest of any artists of Bieber's generation. Saz?
Southwest is set to report results for its quarter Thursday. Given the operational meltdown estimated to cost the airline nearly $1 billion, what should investors be listening in for on the company's earnings call? For more on that, let's get to Melius Research's Director of Airlines and Travel Research, Connor Cunningham. Connor, how bad could it get?
It was pretty bad in the fourth quarter, so hopefully it doesn't get so bad from here. But I think what we're about to go through a big apology tour from Southwest. They're going to apologize to the people they impacted, shareholders, their employees, and so on. So it should be a very interesting call. I think what people are looking for is just how does this deviate from their long-term plan? Do they adjust their 2023 outlook as a result of this? Our initial take is that they probably do not, and maybe they walk back some capacity growth in the first half of the year as they try to normalize the operation. We're still seeing operational struggles today. For example, they've canceled like 6% of their flights, likely due to weather. There's been just ongoing issues, and weather's been the starting point. It's just kind of been a rolling concern across the group in general. But the stocks have all performed decently well so far, so we got to live up to that. The stocks on average are up about 20%. Revenue has been incredibly strong, which has been driving margins up for the group in general. There are some cost headwinds that the industry does face from a labor standpoint, so we'll be listening for that as well. So should be an interesting day. A lot of headlines coming out tomorrow with 4 companies reporting.
Yeah, absolutely, Connor. I mean, when we think about weather, since you mentioned that's really just kind of a catalyst that cascades across the rest of the business as well, and it impacts where they haven't invested enough. Is it possible to even quantify the amount of spending that Southwest needs to implement towards some of that software, as they had highlighted and really led to the larger impact to $725 to $825 million for this quarter?
Yeah, for me, price shouldn't matter. So, we would like to avoid all the operational pitfalls. Like it's just been, and it's not just this year, it's been an ongoing thing for several years. And it's not just Southwest, it's all the airlines and in aviation infrastructure in general. There needs to be more invested just from the airlines themselves and the government. I mean, from what we've done for Southwest in our model, we assume that they're going to spend, $500 million incremental to upwards of $1 billion this year to try to adjust IT investment. It's hard. I don't know how much an off-the-shelf new system costs, but it's going to cost a lot. And honestly, the price shouldn't matter. Southwest has the cash on hand to do something like this, and this is the opportunity to kind of make right what you've done wrong. So we're hopeful that they see that and they adjust. And then from here going forward, that the operation remains the center of everything. Again, if you can't get to your destination, people aren't going to book you. So the concern is always going to be book away to another airline that's doing well. United, for example, highlighted a lot of this on their earnings call. They're saying basically their thought process is that the industry is going to grow or wants to grow domestic capacity on a year-over-year basis by 15%, and they're not going to be able to do it. Basically because of operational issues and other constraints out there. So, it's all about running clean going forward, because that's leverage to the margin profile, not just on the revenue side, but on the cost side in general. So, for me, Southwest, the price should not matter to anyone. They just need to do it. and they need to aggressively do it and tackle the problem going forward.
And Connor, when you are on the call tomorrow, I mean, what do you want to hear from the company on the front in terms of not just that they're going to do it, but how they're going to reassure flyers that they're going to do it? I mean, how does reputational rebuilding work in this industry?
Yeah, well, Southwest does have a great, prior to the meltdown,
Right.
Southwest had a great reputation. And, you know, this, unfortunately, people have short-term memories and they generally book on lowest price or, you know, where they're located and so on. So there will always be a Southwest loyalist. But our biggest concern for them is that one of the big bull points for their long-term strategy is that they were going to go after corporate travel. You can't sell a bad network or a bad operation to a corporate flyer who needs to make the meeting. And so that's a big concern for us. So it's about driving the confidence going forward, getting labor on board. So they have several I have several labor agreements that are open, and they need to get those settled. They need to get them settled super quick. They're already assuming a lot of that cost in their structure right now, but you know the overall unrest on the people side is pretty immense. So it's about aligning everyone on the same strategy. And so they got a new CEO. Bob has been there a very long time. He needs to get everyone on the right page and get them moving in the right direction. As soon as you get the culture fixed and everyone pointing in the right way, things should start to click. You know, is that going to be a tomorrow event? Probably not, but it could be something that happens over the next year. So it's about doing the stuff in the near term that you need to execute on from an operational standpoint, and have that momentum carry through into the years to come. So again, a lot of questions that they got to answer, but you know, hopefully they have a strategy that's in place that will drive some confidence on the operational side.
So given the outsized reliance on a leisure type of traveler, or even a bleisure traveler, if you will, who's kind of mixing business and leisure, should investors be optimistic about bottom line growth for Southwest ahead of a recessionary cycle?
Yeah, so I heard your prior guest, and obviously talking a lot about recession is something that people talk about nonstop with the group. This is a highly cyclical industry. What I would just say is that in the first half of 2023, we are comping against incredibly easy comps. So think about what happened last year. We had Omicron and all sorts of other operational stuff, and just the environment really just wasn't open as it is now. So we're comping against very easy comps. So it's not that hard to get really constructive on the revenue side in the first half of 2023. You know, back half of 23, capacity starts to be added back in the system. That's typically bad for pricing. Revenues could slow as a result at that point, but that's still a ways away. And you know, and what does the recession actually look like? If we're just talking about potential tech job losses and so on, like that may not impact the person who wants to take their vacation that they're going to take that they haven't been able to take for 3 years. Again, like there's been a big shift in what people are buying. I say this a lot, but you can only buy so many sofas. And so, you know, going forward, like what do you spend your money on? It's likely to be experiences. But again, it will depend on how deep the recession looks or how it all looks all together. And so right now we're relatively constructive on the revenue side. What we really want to see for margins to kind of take hold is some work on the cost stuff. We got to get labor done. The industry in general is just being handcuffed by lack of labor deals. And so it drives uneasiness on the investor side until those are done. And so those are done at Delta, Alaska. Those are United starting to include that in their forward guidance. Southwest is already accruing for it. So it's about you know, getting them done now and starting to execute going forward. So we're constructive, but the stocks have moved a lot. You know, earnings they'll have to live up to the stock moves tomorrow. You know, and I'm not expecting any boogeyman to kind of jump out of nowhere. This should be pretty easy going forward for them. It's just about, you know, executing and messaging correctly going forward.
Yeah, the boogeyman already came for Southwest in December,
Yes.
I think, Connor. Thanks so much for the preview. Really helpful perspective. Melius Research Director Connor Cunningham, thank you. Coming up, how disruptive brands are challenging the beauty and fitness industry and how they are coping in a slowing economic environment. That's next. The post-pandemic recovery may have revitalized some brands and led others to a hard rethink about what they're offering. But consumer spending on self-care, from makeup to fitness, does remain a key part of private equity group L Catterton's focus. And joining us with more is Michael Farello. He is managing partner at L Catterton. It's been a long time. It is great to see you, especially in person, Michael. Thanks for coming in. So sort of big picture first. And you guys, in your portfolio, you have things like Tonal, you have the Il Maquillage parent Oddity, for example, as well. We're going into a slowing economic environment, right, which we have talked a lot about. How do these sort of higher end brands, how do you expect they're going to perform?
Yeah, we think they're going to perform well. We'll start there. One thing is the consumer has been quite resilient, as you know. So even with inflation, consumer spending has been robust. And within that, we're looking for those categories that we think can really outperform. And then within that, the brands that can really outperform. And consumers and where they're spending their time and their dollars, health and wellness still matters. And so we're still seeing real commitments into fitness as one particular category. We think it's a category that's been misunderstood in some ways over the last year and what's transpired in connected fitness, but we believe that there's a lot of growth remaining, that fundamentally consumers want that workout at home. It is one that performs better for many. There's still an obsession with metrics, that consumers want that linkage to their data and from their watch and from their ring or whatever they're tracking linked to their fitness. And that tailwind is still there. So we've seen a correction in that category as there was a lot of acceleration during the pandemic, as you know, and there was some catching up over the course of the last year because of some of that forward buying. But we can't change those underlying trends. We're still very bullish in that category over the next 2 to 3 years. Same is true in beauty.
So what is the next catalyst for growth within connected fitness devices, given that one of the detractors has been the Peloton becoming, a quasi just shelf or a rack for some of your clothes? They acknowledge that even within one of their most recent ad campaigns as well. And the other detractor being the number of workouts actually declining after somebody takes on one of those.
Yeah, and it's not an either or, to be clear. So as people have gone back to work, there's some of that migration back to the gyms. You're seeing gym numbers go up, but still a real need at home. So what's going to keep that home equipment compelling? It is the integration into more of the data and being able to integrate with your Whoop or your Apple Watch or your Oura Ring. You look at a business like Tonal that has incorporated real AI that's arguably better than a personal trainer. We think about it as the move from connected fitness to intelligent fitness, where you're getting real recommendations and real guidance. Those same types of innovations are coming in a brand like Hydro that helps improve your form and get a better workout at home. And we think it's a better workout than you'll end up getting in the gym unless you've got a terrific personal trainer, which a lot of people just don't have access to.
For some of these brands that you're invested in, what does an exit look like?
It's mixed. We still see strategics being quite active. Beauty is a great example of that category. We've seen the Unilevers and the P&Gs continuing to acquire some of these high growth brands. But some of these challenger brands are growing to the scale that we do think they'll be public companies. Oddity is a great example of that. Really the fastest growing brand in beauty over the past 3 years online has been Il Maquillage. That is a brand now that is of scale and still high growth and high profitability. We expect that to be the type of company that will be attractive in public markets as they reopen.
Is Tonal, let's focus in on Tonal. Okay. Do they still want to be public given what happened here to Peloton?
Yeah, look, we're still building that business and the company's still building that to be an independent public company and reach a scale to do that. And we think the key to that is that level of engagement. Tonal, as an example, to our knowledge, has the lowest churn and the highest engagement of any connected fitness product. And so it's all about that predictability and being able to have a consistent revenue stream, and that's what we're focused on in both Tonal and Hydro.
When do the public markets reopen? What's going to be the signal to you that is starting to happen for some of these companies?
Yeah, not surprising. It's a conversation that we're having with a lot of advisors and bankers, and there's differing views, but it's a little bit just lower volatility. We think that could happen as early as in Q2 or Q3. And so our view is have these companies ready for that time, continue to focus on growth and profitability, and when the market's open, they'll be ready and they'll be on the front end of that.
We've continued to hear about what AI can be for a lot of different experiences, whether that's search, perhaps even in fitness as well, in those connected fitness devices. If you were to able to integrate into AI, into Tonal to say, hey, we've been reading your metrics, we've been looking through all of the data, this is perhaps what you should focus on next. What role would AI have within connected fitness?
It's a great question. There's so much chatter right now, around ChatGPT and consumers using it. These are practical implications of AI in products like Tonal. We can talk about beauty as well. In Tonal, as you're going through a workout, It senses whether you're struggling with a move or whether you're making that move easily. And it is real time giving corrections to either push you or back off a little bit. Again, making those corrections in real time faster and better than a personal trainer could be. And that really is the key. How do you get the best experience for a consumer, and can you use technology to do that? And we're seeing that across a lot of these challenger brands. So it's happening in connected fitness. And you asked about beauty earlier. It's happening in beauty, arguably even faster.
In discussions on potential exits, does Apple come into play here? Are they in a discussion as a potential acquirer of some of these hardware plays?
Look, we believe that you have major technology companies that don't want to abdicate a room in the house. They don't want to give up a room. And as consumers are spending more time on their personal fitness, that home gym becomes an integral part of the time that they're spending at home. And so in that context, we do think that the larger technology companies have real interest in the category once there's a critical mass around the scale of the user base.
All right. Thank you so much for joining us here today. Really exciting discussion around some of the products that we use on a daily basis, or at least kind of once a week. But thanks so much. Michael Farello.
Be realistic, right?
Yeah, I know.
We're all trying.
We're trying, yes. Michael Farello, who is the L. Catterton Managing Partner. Thanks so much for joining us here.
I appreciate it. Thank you very much.
Appreciate it. Coming up, what Microsoft's cloud results could mean for Amazon. We have the details next. Microsoft cloud growth continues to cool as customers grow cautious amid macroeconomic headwinds. What does this spell out for others in mega tech? Well, here with the details, we've got Yahoo Finance's Ali Garfinkel. What are we tracking in mega cap tech across the bow here as Microsoft has really issued kind of a warning shot, perhaps?
Yeah, Microsoft has certainly issued a bit of a warning shot. It's been very, I would say Microsoft has been seeking to limit expectations, Brad. And I'd say there are three important things to know here. There's good news, bad news, and some meh news. So the good news is the results were better than expected. They came in slightly over analyst estimates on the cloud. And that's great. If you're another big tech company, though, that shows there is pressure to deliver at least solid cloud results coming forward. Next, the bad news. Microsoft is really not optimistic about acceleration, which is that warning shot that you were talking about. This cloud business, other stories might see that where they go, oh, okay, we don't have other companies that are. This is what I'm saying. If the cloud business is slowing down, that's bad news for Microsoft, and they don't think it's going to speed up. And lastly, if you're Amazon, you're watching those results and you are nervous. You are saying, okay, we need to deliver AWS results here because this is a stalwart of the business. If they don't, it looks that much worse for Amazon if they can't deliver slightly better guidance and definitely at least come in over analyst estimates. In the end, Brad, what I'd say is there's pressure right now on cloud businesses to show resilience in really tough times.
And Allie, what are you hearing from investors, from analysts right now about how pessimistic they maybe are in the wake of these Microsoft results? I mean, the stock prices today are definitely under pressure.
I'd say what I've been hearing, Julie, has been that there's going to be a huge gulf between the bulls and the bears from here. I think what we're going to see is we're going to see the people who really believe doubling down and the people who don't believe really doubling down. I think that it's going to be really interesting because in the wake of big tech's terrible 2022, we might actually start to see even more pessimism and even more optimism against the odds. That's what I'm hearing for now.
Well, I appreciate your little bit of optimism there. Allie Garfinkel, always good to see you. We'll talk to you soon, my friend.
Always good to see you.
Coming up, AT&T dialed in an earnings beat in the fourth quarter. We'll speak to an executive from the company coming right up. AT&T out with an earnings beat this morning here amidst some strength in the wireless part of its business here. Let's bring in Jen Robertson, AT&T Mass Markets Executive Vice President and General Manager. Jen, good to see you again. You know, the vibe on Wall Street is that they give you credit for this quarter, but are concerned that some of these trends just may not continue. What's your level of confidence in that?
You know, thank you for having me back. It's good to see y'all again as well. And what I would tell you is we have momentum coming out of 2022 and are very, very proud of the results that we were able to put up growing not only subscribers, but revenue and EBITDA last year. And so feeling good about going into 2023 and certainly including any external factors into our guidance as we look forward.
And so when you're looking at the increases that you all made, Jen, in subscribers, what do you think are the big drivers here? Do you think it is promotions and discounts, or is there something else at work here?
You know, it's the common question across the industry right now. And what I would tell you is it's consistency and simplicity when it comes to interacting with our customers. We made a commitment 2.5 years ago to be customer-centered and to double down, whether it's with respect to the products and the pricing in the marketplace so that they can understand it and get what we promise, whether it's respecting and valuing the loyalty of our customers, and that shows in our fourth quarter churn numbers, but also evolving our distribution model so that we meet customers where they want to be met. And so bringing all of those pieces together has created the ability to have sustainable growth and to both grow top line, but also expand our margins at the same time.
What are you seeing among customers' ability to pay right now, Jen? And is that overflowing into any type of delinquency, whether kind of increased or perhaps even decreased? What's been the net effect?
You know, I think we've shared our commentary on customers and payments. And as an industry, but across all industries, we are feeling the impacts of external factors. Certainly have that baked into 2023. But as we think about our focus on 5G and on wireless and fiber, and we think about our ability to be streamlined and nimble in response to the marketplace, we feel good about being able to adjust. And that's what we were able to do in 2022 and expect to have that same flexibility as we go through 2023.
Jim, pretty sizable impairment charge, I believe, in the wireless business in the quarter. Is that AT&T preparing for a pretty severe economic slowdown later this year?
You know, I think those facts are available on our investor relations website, and Pascal Desroches, our CFO, addressed that in this morning's earnings call. So I'd really encourage people to access that material and take a look at what those write-offs were associated with. They were non-cash in nature, and so certainly didn't impact our free cash flow for either period.
When you think about spending to build out the network even more, we've continued to see some of the network and infrastructural investments be made across the industry. What does that look like in order to make sure that there is that added connectivity that the customers expect, lower latency, as well, even as there is a competitive environment that really moves companies to respond to that demand from customers?
We're excited about the growth of our networks and our commitment to bring fiber to 30 million households by the end of 2025. And we restated that again this morning, that we're staying focused on 30 million households in our footprint by that time. And so that equates to about 2 to 2.5 million households a year. And we have the flexibility as we go quarter by quarter to adjust to ensure we hit that target. And then on the 5G wireless side, again, saying we will bring our C-band or mid-band spectrum to 200 million households by the end of this year. And so being able to deliver both of those high-speed networks is what we do. We do it exceptionally well. And then having the products and the offers on the backside of that to connect customers is how we've really differentiated ourselves over the last couple of years.
AT&T Mass Markets EVP and GM, Jen Robertson. Thanks for taking the time here with us today, Jen, to break down some of the earnings.
Thank y'all. Take care.
Thanks. Coming up, earnings season rolls on. We're going to break down some other results. We've got a look at Kimberly-Clark. That's nice.
Oh, the king of one ply.
Yes. You hear the music, you know what time it is. Time for cut for time. But this day and age, or at least during this earnings season, we're going to talk about some earnings. Kimberly-Clark is where we begin things. Took a hit in the fourth quarter. Volume and sales declined more than expected. But the Kleenex maker did see a silver lining with its profit coming in above estimates. They also had delivered a 7% organic growth, the company is saying, and an average of 4% organic growth, 3-year basis here. And so, yes, in the big debate in the office this morning of one-ply versus two-ply, Kimberly-Clark found itself at the intersection.
No, it's not a debate. Nobody's on the one-ply side.
One-ply should be banned by the government. If you could see your hand through a piece of toilet paper or Kleenex, it is not going to end well for you on that particular moment. It's just going to be an awful experience. But to that point, it looks like consumers have pushed back against some of these Kimberly-Clark price increases. In that consumer tissue business, selling prices up 11%, volume down 6%. So maybe people are just running around with wet noses.
Net selling prices were up. They were up 30%. So you pass that on to the consumer, and they're saying, "Wait a minute, 30% more for my two-ply."
Yeah.
Maybe the hanky's coming back.
The hanky? Oh, we could really. Yeah. Okay, guys. All right. Tesla bulls unite. Morgan Stanley's Adam Jonas is naming the EV maker as his top pick ahead of its earnings report after the bell today. Jonas says Tesla has room to undercut the competition. So big call by a friend of the show, Adam Jonas, always making those big calls on Tesla. And this is a big call. This is probably one of the most important earnings calls from Tesla in recent memory. And Brad, I knew you and I will be ready to rock live on Yahoo Finance as soon as that call ends around 6:30 or hopefully 6:30.
Yes, we will rock you live on Twitter Spaces as well, and on the Yahoo Finance app. But Elon Musk mentioning, or Adam Jonas within this note mentioning that CEO Elon Musk has been distracted since his purchase of Twitter in late October, and that he raised money partly by selling some of his Tesla shares. Of course, that has been reflected in the stock that has been reactive on each of those share sales, even when Musk said, yeah, I'm going to stop selling shares. There's no way he could finance the deal without selling more shares, though.
Right. Well, all of this is, we'll see if it actually affects the sales of the cars, right? That's the bottom line.
I think Elon's one-ply or two-ply. He's a two-ply guy. He's got the money.
Five-ply. He's got the money. Intuitive Surgical is warning of further headwinds to come in China, saying the latest wave of COVID triggered a volume decline in November, which will likely spread in the first quarter and beyond. The company is also not going to be launching a new multi-port robotic system this year, and that seems to be a big disappointment for analysts. In fact, one analyst said the quarterly results were uneventful. There wasn't much to pay attention to there, but then the call and guidance for not introducing this new system was not a good look from the company, and that's what's setting the shares down.
Yeah, I have the same commentary that I had in our morning meeting. This is the company that did surgery on a grape, and for many of the people that had seen that viral video from Intuitive Surgical and the Da Vinci system that they developed, it really is kind of a question of what more research and development can continue to be done. How much more do they have to spend on making sure that they have not just viral videos, but of course some of the game-changing technologies to ultimately change the way that surgeries are done. And
I'll be honest, when and if I go under the knife at some point over the past next 30 years, I want a human. I want a human doing it to me. I mean, I respect what they're doing here, but I'll take Joe the doctor.
I don't know. Humans' hands can shake.
Yeah.
Robots don't.
Yeah.
Maybe. Let's take a look at markets before we leave you and move on from our surgical preferences. We've got all three major averages that are down. The Nasdaq in particular taking a big hit. It is down by 2%. Microsoft obviously is a big part of that, and not just Microsoft itself, but the Microsoft ripple effect that we have been talking about all morning long. Those shares are now down a little more than 3%. And we're seeing other cloud providers, you guys, also continue to feel the pressure.
Yeah, our producer really, good point by Val Cavallo, our producer here on those robots for Intuitive Surgical. They're not going to fight for our life, Brad. That's the human component right there. They're going to keep me alive. Deep, right?
Deep. Right.
On market sell-off day. Big deep, very deep.
Maybe. Getting back to some of the other companies that were moving lower off of Microsoft, though, we saw Datadog, DocuSign, and then additionally one other.
MongoDB was one of them.
Yes, exactly. And so,
are you ready for later? You psyched?
I'm pumped.
I'm pumped. I'm ready to go.
It's going to be great.
First time we've done this here at Yahoo Finance. I'm excited. There we are. That's Brad. I think he's going to be wearing his purple sweater for that later. I'll look for my purple tie and maybe my Patagonia vest. I'm psyched. I'm ready to rock. Yeah. First time we're doing this, and I think it's going to be very helpful to a lot of investors on our platform.
They're going to see the view from my desk, and I'm also going to go pick up my purple sweater from Hot Topic a little bit later on.
Okay, and I'll be back here with you guys tomorrow morning talking about all of it. Rochelle Kufo is going to have you for the next hour of trading, though. She's going to take a deeper dive into those Microsoft results. Keep it right here.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Kufo. Here's a look at what I'm watching this morning. Stormy clouds ahead for Microsoft. The company warns there will be more deceleration ahead after reporting its slowest revenue growth in 6 years. And trouble in the skies. Shares of Boeing skidding in the pre-market after the company missed estimates on the top and bottom lines, blaming labor and supply challenges for the disappointing numbers. Plus, from EVs to cannabis, we'll speak to one auto executive who's getting off the road and into the greens later this hour. But first, let's check on markets. 90 minutes into the trading day, we see that all three in negative territory. Obviously, markets digesting this earnings season, tracking these themes of economic uncertainty. We see the Dow there off more than 1%, the S&P 500 there down more than 1.33%, and the tech-heavy Nasdaq, we see it's been driven down by Amazon, Microsoft, Google, and Tesla at the moment as we try and brace for this earnings season, especially with Tesla earnings after the bell today. All right, let's also check in on what we're seeing in the Treasury market. We're seeing that all of those are retreating at the moment. We're seeing the 5-year down 0.6%, the 10-year off just about 1/3%, and the same situation for the 30-year. Obviously, the bond market expecting the Fed to slow its tightening on improved inflation data when it meets next week. Right, well, let's kick things off with Microsoft shares sliding into the red following its latest earnings report as the tech giant leaves investors weary with its downbeat outlook as it sees further growth slowdown in the cloud. Well, what could this all signal for the rest of the megatech names? Here with the details is Yahoo Finance's Dan Howley. Hey, Dan.
Rochelle, we had Microsoft report slowing cloud sales in the quarter, and it was not as bad as seemingly analysts had expected. But the bigger problem was the Q3 guidance that Microsoft had issued, basically saying that, look, we're going to continue to see deceleration in this cloud area as a result of the broader macroeconomic conditions. And so this has been something that's been going on for quite some time. It's not necessarily just this quarter. So it's surprising to see analysts react when they said that they saw it better than expected results from the cloud business. The acceleration that we saw from sales during the pandemic was astronomical for sure, but we've seen them come down quite quickly as a result of that kind of pullback. And so now moving forward, we're expecting to see further deceleration. I think the other thing to point out for sure is the PC market. That really kind of stung Microsoft hard. They were down 39% for their Windows OEM business. That's where they basically sell Windows licenses to PC manufacturers. And as a result of that slowdown in the market, we're seeing this pullback in the number of people that are going out and buying PCs. And that also applies to their own Windows hardware business, where we also saw slowdown as well. So, overall, this doesn't paint a great picture for other cloud service providers or PC manufacturers. We have Intel reporting tomorrow as far as the chip side of things, so we'll get a better look at what that means for hardware. But for the cloud, it could spell trouble for the likes of Amazon and AWS and Google and their Google Cloud platform.
And obviously, Dan, a lot of people turned to these tech companies when they didn't have a choice during lockdown. So we knew there was going to be sort of an untangling of this as consumer demand changes. You have to wonder, though, is Microsoft any better or worse positioned than some of these other big tech companies?
It's interesting because they are the second largest by volume cloud provider on earth, just behind Amazon. Google is in third, followed by a slew of others. But as far as how they've managed to package and offer their kind of cloud products, they've done a great job. And so, once we start to see perhaps a kind of push forward as far as companies going out and starting to rebuy some of the cloud offerings, then that could really start to improve for Microsoft. They purchased, obviously, or didn't purchase, but invested that $10 billion in ChatGPT creator OpenAI. That should spell good news for them down the line, especially since it's not just ChatGPT. That's just a chatbot. It's the technology behind that. I know a lot of people have discussed ChatGPT being, kind of the big, interesting product that's available, but it's the technology behind that provides that natural language conversational that you'll have with the AI. And so that's something that I think obviously helps Microsoft differentiate itself, especially since Microsoft is going to be the exclusive cloud provider for OpenAI and what it has to offer. And at this point, they're doing all of this calculations and activity in the cloud through OpenAI. So that really does give Microsoft a boon.
Certainly positioning for the long play there. Dan Howley, thank you so much for that update. Well, it's a big week for tech as Microsoft earnings kicks things off with a less than desired outcome as its worrisome guidance hits other mega tech names. We're here to dig deeper on Microsoft and the rest of the tech space is Robert Stimpson, Oak Associates co-CIO. Good to see you, Robert. So as we were taking a look through some of the revenue drivers there for Microsoft, Azure stood out. And we know that you said that's one to watch, but obviously getting a lot of the headlines is that investment in OpenAI. If you're Microsoft, how should you be putting your capital to work right now?
Well, we think the OpenAI investment into Chat GPT is the type of decision you want to see from a mega cap tech name like Microsoft. We do not want to see them sacrifice those opportunities to the likes of Google or Amazon or Facebook. So we're encouraged by that sort of investment for the future.
And so as we look at Azure especially and where it's going from here, and then when you compare it to what we're seeing with the cloud business, some of these growth drivers that allow them to be able to pour innovation into these other sectors, what are your expectations for the cloud business?
Well, the cloud is certainly the growth business for Microsoft. And when we look at the stock today, it's really a tale of two cities. They have the PC business, which is slowing and mature, and then they have growth in the cloud business. And that's definitely the area that's the market is watching. It's been successful, and a little softening going forward is to be expected, because after all, this is a $52 billion revenue company. It's hard to maintain that revenue growth. And I understand that businesses are kind of rationalizing their spend after 2 years of trying to be more efficient, more productive coming out of COVID.
And so, Robert, then I know that one of the negatives that you highlighted was the current valuation, especially when you look at, say, a Google or a Meta. How are you, when you think of where the valuations might go from here, what do you think might actually work in Microsoft's favor, since they do still have such a high valuation?
Well, I think they've been benefiting from the idea that as a mega cap tech company, there is some safety and security in their size and their market cap. But when you separate Microsoft into those two industries of being a legacy PC company and a growth cloud company, the valuation multiple should probably somewhere in between of those two businesses. And unfortunately, it's not. It's definitely more towards the higher end at 24 times next year's earnings, price to sales of almost 9 times. Those are pretty rich multiples when other tech names have similar growth opportunities, but are trading at much more reasonable valuations. Whether it's Google at 18 times earnings or Facebook at 13 times earnings, other mega cap names just don't have that premium. And we think that the upside is still good in those areas.
And so when we look at some of the issues that we're still dragging in from 2022, the macroeconomic backdown, Fed continuing to tighten, albeit at a slower pace, when you look at some of perhaps the potential for the biggest winners this earnings season in tech, who stands out to you?
Well, we do like the semiconductor space. People forget it's a boom and bust cycle in semiconductors. And, we had some supply disruptions during the pandemic, but valuations have contracted sharply. China is reopening. The appetite for semiconductors is still very strong. So, as an industry, there's some inventory that needs to be worked off in some of the more industrial, automotive, and PC names, but it's still a growth industry that you can get access to at a much more reasonable valuation, knowing that it has a long tail of growth behind it.
And Robert, I want to ask you about layoffs. Obviously, we've seen Microsoft part of that as well with its own set of 10,000 layoffs. Haven't heard anything from Apple yet. Apple have done hiring freezes, but haven't made those cuts yet. Do we expect much deeper cuts overall for tech? And why do you think we haven't seen it for Apple yet?
That's a good question. I expect we probably will at some point. All of the tech companies were aggressive in hiring during the pandemic. They kind of benefited from the work from home trade and enabling other companies to move to a more distributed workforce environment. And there's going to need to be some rationalization of that workforce going forward. So I think that the layoffs we've seen from a lot of the major tech companies is probably just round one. I think Microsoft hired something like 75,000 people over the last 4 years. And last year, headcount was up over 19%. So as these tech companies make their own expense reductions, headcount's going to be a big area.
And Robert, of course, we know that Tesla's reporting after the bell, but I do want to ask you about Musk. A lot of people, especially investors, frustrated about the distractions. You have Twitter, you have the ongoing shareholder lawsuit. How do you think this is all going to pan out for Tesla, since it does have some very ambitious production targets now?
Well, Tesla has a great product, a great car, but the stock has been very volatile, and Elon's personality is affecting its share price. So while the underlying product is good, the high valuation, as well as some significant changes in the competitive environment over the last 2 years. I think every major automaker now has a lineup of EVs available, and Tesla is no longer, the best option for some people. So given the changes in the competitive landscape, the stock's been under pressure. Elon's been a little bit of a distraction. And as a result, it may not ever receive the premium fan base or valuation that it had enjoyed previously.
Certainly is a very different time we're living in now in the EV space. Robert Stimson there, Oak Associates co-CIO. Thank you for joining me this morning. Right, well, earnings season is in full swing, and while Microsoft may be the talk on the street today, we're taking a look at some of the other biggest movers of the day with Yahoo Finance's Inez Ferre. Inez, what are you watching?
Well, Rochelle, I'm watching the #2 trending ticker on Yahoo Finance behind Microsoft, and that would be Boeing after Boeing reported its quarterly results. Take a look at our Wi-Fi interactive board. This is the Dow, all 30 components of the Dow there. And you can see Boeing, one of the biggest laggards on the Dow, down almost 3% after a fourth quarter loss of $1.75 per share, missing estimates, Wall Street estimates of a profit. Its revenue came in at $19.98 billion. That was also a miss. Some commentary from analyst Cowen saying that the results miss suggest a broad-based softness in operations. You still, though, have 19 buys and 6 hold, 0 sells on this stock. Another stock that I'm also taking a look at is in the semiconductor space, and that would be Texas Instruments. After the company reported its quarterly results, the stock down almost 2%. That's partly because of the biggest sales decline for Texas Instruments since 2020. The company also issued weaker than expected guidance, saying that it's seeing a slowing demand across different industries, except for the auto industry. And Texas Instruments is an important stock to look at, an important company to look at, because it has almost 100,000 customers worldwide across different industries. So you can really get a gauge of where we're at with the semiconductors. And then just taking a look at ASML. This is a company that manufactures equipment for making semiconductors, and it topped its earnings forecast. Its sales is going to grow in 2023. That is according to their predictions, their projections. But it did call out the Chinese controls on exports, and that this could impact the company because the chip technology has sort of become a security concern when it comes to China. ASML warning that excessive export controls could inflate chip costs. It could also impact supply chains. Some of the top customers, by the way, for ASML is TSMC and also Samsung and also Intel. So another important company to watch because they make the equipment for making semiconductors. Michelle.
Indeed, a lot of people keeping an eye on that China reopening story. So big thank you there, Inez Ferre.
Thank you.
All right, coming up, it's time to put your money to work for you. When we come back, we dive into where you should invest. Stick around. 2023 is the year to put your money to work, but a real tangible asset's the better bet. Let's take a closer look at the infrastructure behind energy, agribusiness, and the bearish sentiment holding back investments in Europe. Joining us now is Greg Swenson, Brig McAdam founding partner. Good to have you on the show, Greg. So I know that we're mentioning Europe there. You're saying it's not the time to buy, at least not yet. What are some of the factors that are driving that outlook?
Yeah, I think there's maybe too much optimism right now because the winter wasn't as bad as people expected. It was so far a relatively warm winter, and the Europeans, led by the Germans, were able to cobble together enough energy supply. So the energy crisis is not quite as bad as a lot of the market expected. But I think that doesn't really help us next year in terms of energy supplies. So I think that's the real concern. Next year, you still have some inflation. In spite of the fact that the Germans and other countries were able to get some supplies in, and the winter's been kind to the market, you still have much higher energy inflation in Europe, and that's a headwind to the market. So look, I don't think long term it's such a bad move. In fact, if you look at the worst performers of last year, small cap Europe and as well as small cap US for that matter, were some of the real laggards. So I think there will be a time once we get through some of the headwinds, see how earnings are in Europe, relatively or historically, it's relatively cheap to the US markets. So I think there is going to be some opportunity, and because small cap Europe really lagged last year, I think when the Fed is done, when the ECB is close to done with tightening, and you start to see a potential move back to easing toward the end of this year and early 24, it'll be time to dip your toes into the European markets.
So, Greg, we know what you're not keen on, but what about what you are keen on? You're talking about some of these more tangible investments. Break down some of that, because you talk about alternatives and real assets here.
And part of it is the timing. The last year, since the Russia invasion of Ukraine, you saw an elevated interest in critical infrastructure, notably in food security and energy security. That's not something that's changed for us. It just, as I said, elevated it to front page news. But energy infrastructure, food security, and energy security have been exceptional, non-correlated, and inflation-protected investments. So in whatever your view is on inflation, whether it's coming down or whether this is a bit of a head fake, you can invest in real assets that are critical infrastructure and really address the basic needs. So there's a lot of opportunity in those sectors, and we would advise looking for opportunities, especially in emerging markets. You saw, Latin America performed really well last year in terms of fixed income because it's correlated to commodities. You'll see that opportunity in Africa and other emerging markets and frontier markets that are correlated to commodities. So long-term view on critical infrastructure is still very positive.
And what about in the shorter term and the midterm? I know that you're also keeping an eye on the real estate investment as well. What sort of trends are you looking at? And what are the factors that really make for a good investment in real estate right now?
Yeah. I think, look, there's still some headwinds. I think you've got obviously high vacancy rates in the office sector, especially in cities like Chicago, which you should probably avoid. But I think, that it was, speaking of sectors that did really poorly last year, real estate was one of them. So I think as the mood shifts later this year from, getting through the recession, regardless of your view on whether it's going to be severe or not, or even a soft landing, as the sentiment changes toward the end of the year, I think a move into the real estate sector in general. And then also, we look at opportunities in emerging markets. I mentioned Africa, but also in Latin America and Asia. If you have markets that have underperformed, the most important thing in those markets is if it's dollar correlated and you have off takes in dollars and especially with good credit, leases, I think that's a real opportunity, and we see a lot of interest in those sectors.
So for perhaps newer investors who are wondering, should I hold on to my cash? Should I try and enter the market through an ETF? How would you advise them in terms of making the decision as to the way they should be heading right now, since there is so much uncertainty in the economic backdrop?
Right now, to me, it seems really obvious. If you can buy T-bills at in the fours, 4.5% for 6-month bills, roughly. That I think is a great way to get through this uncertainty, get through some near-term volatility with this inverted yield curve. Hold off on long-duration assets, both long-duration equities like tech. I think the tech rally was premature. The valuations aren't that cheap, and same with long-duration fixed income. You have an inverted yield curve, so put your money to work for 6 months in T-bills or high quality money markets that are, in 4.5% to 5.5%. Why wouldn't you do that for the near term and then start to make some long-term rotation decisions toward mid-year or toward the end of the year? And in the meantime, stay defensive.
All right, there you go. Stay defensive. Greg Swenson there. Brig McAdam, founding partner. Thank you for joining me. Thank you for your time. All right, well, Amazon's clashes with unions continues. Workers in the UK staging a day-long strike over wages and working conditions. The action marks the first time the e-commerce giant is seen in that country. Here with more is Yahoo Finance's Alexandria Garfinkel. Hey, Ali, how are you?
Good to see you, Rochelle. So the UK strike is expected to last 24 hours. It started at midnight, and it's important to say off the cuff that though this is the first strike we've seen in the UK, this didn't happen overnight. These workers in this Coventry warehouse have been very outspoken since last year about their working conditions. They've been working with the GMB union, which is a general trade union in the UK. And this strike in particular, they actually voted for it at the end of last year. So I think this shows the extent to which organizing at Amazon has really begun to have a playbook. And that playbook, of course, has been heavily influenced by the Amazon labor union. Its victory in Staten Island did change the game last year, simply by proving that it was possible. Of course, if you're Amazon right now, this is a headache you don't want. You're coming into a very important earnings, one of the most high stakes earnings you've seen in a while. And this is just another distraction. This is something that is going to be playing out for them for a long time. And the fact it's coming to a head right now, I'm sure isn't exactly what they were hoping for.
And investors really keeping an eye on the domino effect of some of the success that these unions have seen. Now, this most recent strike action, though, indicating some momentum for unionization at Amazon. How are these efforts, though, positioned in 2023?
That's a great question, Rochelle, because on one hand, there's momentum, and you cannot overstate how important momentum is to a union effort. These efforts are massively benefit from momentum. And the fact that COVID changed things for workers, changed what they were willing to talk about, what they were willing to organize for, is something that I think a lot of these unions and a lot of these efforts are still absolutely riding on. On the other hand, you have Amazon, and they're going to fight unionization tooth and nail. And workers have this incredible task then of outlasting Amazon. Bargaining periods are already more than a year, about 465 days. And Amazon has shown with the Amazon labor union's victory that it will fight even certifying wins at all. So for workers who are even just waiting it out here, it's going to be a tall order in 2023.
Certainly does seem to be an uphill battle, but seeing some success, though, at least for unions. A big thank you there, Ali Garfinkel. All right, time now for our chart of the day. Now, the US isn't the only country feeling the heat from higher inflation. Australia's own inflation print recording a 32-year high. All this, of course, indicating rising prices for consumers there in everything from new builds to staples and food. Inflation has been a key target for most central banks worldwide as the stimulus and lower rates introduced during the pandemic era are fading out. All right, coming up, crypto lender BlockFi had over $1 billion in assets tied up between Sam Bankman-Fried's FTX and Alameda Research. We'll get into the crypto corner next. A mistaken upload by BlockFi now reveals the crypto lender had over $1.2 billion in assets tied up between Sam Bankman-Fried's FTX and Alameda Research. Well, for more on the implications for the crypto space and BlockFi creditors, let's get to Yahoo Finance's David Hollerith. David, what an unfortunate update.
Yeah, so last night, M3 Partners, an advisor for BlockFi's unsecured creditors committee, mistakenly made this upload. And the mistake is that a lot of the information was unredacted in a presentation. And the presentation showed that the crypto lending platform had about $1.2 billion tied up with FTX and its related trading firm Alameda Research. And as we know, FTX bailed out BlockFi over the summer, then swiftly sent it into bankruptcy in November after FTX collapsed. And that $1.2 billion included $415 million in assets held with FTX, in addition to about $830 million in loans to Alameda. Now, the number was reported at BlockFi's first bankruptcy hearing as being $1 billion. And obviously it has since risen. The presentation, which has been removed as of now, and we'll see if that stands to be the case, given that it's already been revealed to the public, also showed that after adjustments, BlockFi has about $1.3 billion in assets, which is a little less than half of which is liquid, meaning it's easily sellable. The document also showed that between the period of May 2022 and up to its bankruptcy filing, approximately 73% of its 662,000 customers were retail investors with $1,000 or less in their accounts. Now, this is all to say bankruptcy claims for BlockFi at this point in time are selling at about 23 cents on the dollar.
So then as people wonder what this means for some of these crypto companies, are there any implications here for Coinbase's quarterly results? How bad could the damage be?
Yeah, Coinbase got ahead of some of the news or some of its Q4 earnings earlier in January by releasing preliminary statements on it. And we already have a lot of data outside of that based on its crypto trading volume, which is publicly available. But to put it into perspective, crypto exchanges have been grappling with what can be described as a huge loss of customer confidence since FTX. And Coinbase is a standout exchange, being that it's one of the only publicly listed cryptocurrency. It's the only publicly listed cryptocurrency exchange. And broadly speaking, during the entire year of 2022, cryptocurrency prices declined on average by about 64%. And Coinbase's revenue is heavily tied to trading volume. And Coinbase's CEO has also pointed out that they expect revenue to decline by half or more for the whole 2022 year. Now, in terms of what we can expect for Q4, the company's trading volume declined by about 9% compared to its third quarter. So we should expect things to be worse. Analysts are anticipating an earnings per share loss of between $2.39 and $2.49. And those are estimates, obviously, at this point in time, as we have about 3 weeks until Coinbase does report Q4 earnings. And of course, the company has also announced a plans to lay off 20% of its staff earlier this month. And that will be between Q4 and Q1 of 2023, with the aim to cut operating expenses by about 25%. So over 2022, Coinbase cut about, or I guess we could say since cryptocurrency prices plunged, Coinbase has cut about 2,000 workers. So the big question here is whether or not these cuts are going to impact its development of becoming sort of what it's been hoping to do is more than just a crypto trading venue. But that being said, for the quarter, I think that we're going to see them focusing heavily on crypto trading volumes. And we'll want to see if FTX at all, the collapse of it impacted their exchange or customer levels on the positive side.
We'll certainly be keeping an eye on that. We're seeing a lot more retail investors now relying on hard wallets and trying to come off some of these exchanges in light of what happened with FTX. Great update there. Dave Hollerith there. Thank you so much. All right, coming up, how can the government help you save money this year? We discuss tips and tricks to protect you against inflation. Stick around. If rising interest rates have thrown you for a loop, Treasury inflation-protected securities, aka TIPS, could be a safe bet to protect your cash. Joining now with tips for tips is PF Wealth Management Group President and Managing Partner Frank Paré as part of our Financing Your Future segment brought to you by Synchrony Bank Savings. Good to have you, Frank. So break this down for us, because a lot of people are wondering, should I just dive straight into bonds? But as you're mentioning here, there are some alternatives people should be exploring.
Absolutely, and thanks for having me, Rochelle. TIPS are an alternative to consider. However, if individuals are looking for a short-term sort of take advantage of inflation being relatively high, I wouldn't necessarily say go with TIPS. TIPS are, again, Treasury bonds that are backed by the full faith and credit of the U.S. government, and they're meant for long-term investors. And the best thing to kind of consider when you're looking at TIPS is whether or not you're buying them in a retirement account or a taxable account. Because even though TIPS pay out twice a year, what happens is the interest, or at least the returns, are accrued. So it's not as if you're going to get that check in your account. Instead, you're going to have it applied to the principal. However, from a tax standpoint, you're going to be taxed on it as taxable income. So in terms of earnings from TIPS, the best way to invest in them is to do them through a retirement account.
And so how have they fared since the Fed started raising rates? What sort of returns are we seeing?
Yeah, so TIPS didn't do so well last year, and in part because, again, yields were up, and as a result of yields being up and the TIPS prices going down because of the inverse relationship, they didn't do so well. However, Again, this is for those individuals who were looking to make a quick profit as a result or trying to take advantage of inflation. Those were not exactly the best investments. If, on the other hand, you are a long-term investment, then TIPS are still a pretty good investment, and there are some opportunities. The thing to keep in mind is when TIPS are out there trading in the secondary market and the prices are being adjusted to inflation, something to note is if you're buying them when the adjustments are high, well, now you're looking at what happens when inflation goes down. And that's when TIPS are adjusted downward. So something to keep in mind is if you're looking at TIPS, don't think of them as a short-term hedge against inflation, but more or less a long-term hedge against inflation. So yeah, they didn't do so well last year, but I wouldn't necessarily say there aren't opportunities now with respect to investing in TIPS and using them as part of your long-term strategy.
And we've looked at tips in regards to retirement accounts. What about for non-retirement accounts and the I bonds? What are you looking at there, and how should people be investing there?
Yeah, another great inflation protection investment. However, the difference between tips and I bonds are tips you can invest upwards of 10 million. With I bonds, well, you're limited in terms of what you can purchase during the year. You're limited to $10,000. In terms of that investment, you can go as low as $25, and the maturities, of course, range. But again, you're getting an opportunity to take advantage of inflation. In other words, you're buying these I bonds with a long-term view that over time, you're going to beat inflation. The good thing about I bonds is the fact that the interest, you can decide whether or not to pay the taxes on the interest annually or at the time of maturity. And I should add, just like with all treasuries, you're not taxed in terms of the tax on those bonds are not taxed at state and local taxes. So you get a break there if you're living in a state like I do here in California.
And so then who isn't this a good fit for? I know because we've talked about this being a longer term investment here. Who is this sort of investment not a good fit for?
Yeah, great question. Again, these are not the best investments for individuals who are looking to park their money for short term. In other words, if they're looking to park their money for less than a year, neither of these are great investments. In fact, with I bonds, you must hold on to them for at least a year. And if you were to redeem them within 5 years, you're going to lose out on 3 months of interest. So for the short-term investor who is looking to park their money, these are not good investments.
Certainly, everyone make sure they do their homework. Frank Pare there, PF Wealth Management Group President and Managing Partner. Thank you for your time this morning.
Thank you, Rochelle.
All right, well, thank you. You're very welcome. Well, Shopify is taking a hit, but turning it around as we see as we roll into the new hour with a rollout of Buy with Prime and Amazon feature that allows merchants outside its platform to use the company's payment and delivery services. So far, roughly 3/4 of surveyed Shopify merchants are considering using Buy with Prime. The development does pose a threat to Shopify's merchant solutions revenue, which accounted for about 70% of its revenue last quarter. Though the Buy with Prime feature can help Amazon build trust with merchants, it does have a hefty price tag. The service costs merchants over 1/5 of their sales revenue per order, so perhaps some movement here for Shopify if they can get in at a better price. All right, coming up, from wheels to weed, how one automotive executive is making the jump into the cannabis industry. Stay tuned. a former senior executive in the luxury automotive industry, now leading a new cannabis lifestyle brand looking to cater to affluent, high-class consumers. Mark Del Rosso, Liberté founder and CEO, joining us now to discuss his shift from luxury vehicles to navigating the cannabis market. Thank you for joining me today, Mark. So this is quite the shift. Walk us through how you got from your previous industry in automotives to now cannabis.
Well, thank you, and thank you for having Liberté today. First, I think I start with the journey from automotive into the cannabis. At the root and at the essence is really a personal belief. When I contrast the two, from an automotive perspective, I always believed in transportation and the freedom that comes with transportation. When I look at the cannabis market, I have a deep belief in the plant, the cannabis plant, and the freedom to express yourself through the plant and the benefits of the plant. When I look at the opportunity and to contrast the two, in the opportunity in automotive, I'm fascinated what's happening with battery electric vehicles as an example. I read a statistic by 2030, 50% will be battery electric vehicles. When I learned more and more about the cannabis industry, an industry that's going to grow to 70 billion by 2030, it really provided an opportunity to lead. 68% of Americans believe that cannabis should be federally legal, 34 states medical, 21 recreationally legal. So it really gave us an opportunity at Liberté to found a company that is really specifically around a modern, high design cannabis company, really focused at a discerning audience. And we really believe that that audience is into culture, status, and sophistication, and they want the very best. In addition, when I look at the journey, I think about the ability to innovate. And taking automotive as an example, alternative propulsion, battery electric vehicles. When I think about the cannabis market as well, clearly an opportunity to innovate and pioneer in the space of solventless extraction as an example, direct to consumer, and really around our company, libertéus.com, it really gives us the opportunity to design and curate from products to experience. So it's been an incredible journey. I'm learning a lot.
So Mark, I want to ask you then, are you expecting much crossover in sort of your high-end clientele in cars and your high-end clientele that you're catering to as your website has launched today, and I guess you're going to be rolling out in California and the sort of other accessories along the way?
Yes, well, thank you for that. We do believe that there's a crossover, and quite candidly, again, going back to the consumer, and we serve the consumer, our mission is to elevate cannabis in society. And when we think about that discerning consumer, we think that we have the ability, again, to curate around that. I believe, from a launch perspective, we'll launch in the spring a full lineup of lifestyle products available throughout the United States, and then premium cannabis products in the state of California with a passion around solventness. We'll focus primarily on Los Angeles and the Los Angeles area, and then expand throughout the state of California. But yes, we see that crossover because we do have the access and we do have the credibility.
And so, Mark, I want to ask you, obviously, in terms of the regulatory environment, it is a bit piecemeal, it is quite patchwork. How do you see that affecting how your business grows from here?
Yeah, I think it's interesting, and we're learning an awful lot. And I really love Elon Musk bringing up the whole idea of first principles and really getting down to the truths and then reasoning up from there. And I think that it's important when we look at regulation. Again, I believe in America. And again, as I stated, 68% of Americans want cannabis to be federally legal. And the reality is, when I think about that and I think about the truths, the lessons learned, whether it's in California, New York is now coming online, there's an opportunity to continue to innovate and continue to get better. And that's where we think pioneering is so important. And also, I think the legislation will follow, always getting better and always reasoning up.
And obviously, people are wondering perhaps about some of these price points for the products and services versus, say, what you might get at a dispensary. What sort of price points are we looking at?
Yeah, for us at Liberté, again, if you want to learn more about our company, it's libertéus.com. We really believe that our pricing reflects that idea of creating the best-in-class value for the client. It's really a connoisseur grade and the curation of the finest. So our range will be anywhere from $50 to $1,000, but again, it's creating value within the segment and within the industry.
I mean, we've seen luxury buyers, stick with it even through inflation. So I'm guessing perhaps if that's the market here as well and there's crossover, you might see that growth there too. A big thank you there to Mark Del Rosso there, Liberté founder and CEO. Thank you for joining me today. All right, coming up, rising egg prices are no joke, and one US senator is asking the FTC to crack down on whether or not egg prices are being manipulated by producers. We discuss next. Washington is looking to crack down on the price of eggs. Senator Reid sent a letter to FTC Chair Lina Khan asking the agency to open an investigation into potential price gouging by major companies. Brooke DePalma is here with more. And we know we've been watching these egg prices continuing to rise.
Certainly watching them, and Senator Jack Reed joining the conversation this morning with that letter to the FTC chair. In that letter, he basically urged the Federal Trade Commission to open an investigation into potential price gouging and other deceptive practices by the country's largest egg companies that appear to be contributing to cost increases for American consumers. Now, in that letter, he calls out one company in particular, the #1 shell and egg producer, Cal-Maine, which controls about 20% of retail market share and about 14% of the egg-laying flock, because of this quarterly record income. As you can see, in 2022, the net income for the company was $323 million compared to this time last year, a loss of nearly $17 million. Cal-Maine responding to these accusations in a statement posted to its site saying, quote, many factors play a role in increased egg prices, most notably the recent impact of the highly pathogenic avian influenza, which has significantly reduced the national hen supply, while consumer demand for shell eggs remains good. Now, consumers might have seen Cal-Maine's eggs at company or stores rather like Walmart and Aldi and Kroger's. So certainly they are aware and they do see these eggs on the shelves. But right now, a dozen grain large eggs are going for about $4.25. And Rochelle, that's up from $1.79 this time last year.
Good grief. And I mean, we know that the organization Farm Action also jumping into this debate. What did they tell Yahoo Finance?
That's right, Rochelle. Joe Maxwell, president of Farm Action, that's an advocacy group for farmers and consumers across the nation. They told Yahoo Finance that the numbers here are simply not adding up.
It's obvious that the avian flu is real. 50 million laying hens lost, but from 2021 to 2022, that reflected a loss of production of eggs in this country by 5%. 5% is a number, it's a real number, but it does not justify 138% increase at the grocery store, nor 960% increase in gross profits for the largest egg producer in this country, who has not experienced one case of avian flu.
And in addition to Senator Jack Reed's letter to the Federal Trade Commission, Farm Action also wrote a letter of their own citing price gouging and collusion in shell egg sector. Yahoo Finance did reach out to the FTC for comment, and they declined to comment on this, Rochelle.
I mean, people are probably wondering, consumers, when can they expect some relief at this point?
Yeah, Rochelle, as we continue to chat about this, a lot of economists saying that as that egg-laying flock continues to rebuild, we'll see those prices go down into the end of 2023. But certainly we're caught between the holiday season and Easter coming around the corner. So as we see this increase in prices, that's expected to increase or rather stay higher for quite some time.
Yeah, I think people will be going with the plastic eggs for some of their Easter egg hunts this spring. A big thank you there, Brooke De Palma, for joining us. All right, well, before we go, let's do a final check of the markets. We see that all three major indices still in negative territory, but off their session lows. The Dow, they're at least gaining some ground back, but still down about 0.5% on the day, 170 points. The S&P 500 also down about 0.7% there. And the tech-heavy Nasdaq at least bringing back some gains, but still weighing the heaviest as we head into the noon hour, down almost 1%. Well, that does it for now. I'm Rochelle Akufo. I'll be back at 11 a.m. Eastern tomorrow. I'll see you then. Alphabet, Microsoft, Amazon.